We're going to go right ahead and get started then with today's discussion. Today's discussion, AOD UTP lesson, is going to be on the Wealth and Freedom Strategy number 4. Okay, we're going to be talking about Wealth and Freedom Strategy number 4. The Wealth and Freedom Manual can be downloaded directly from the handout section of this webinar, or if you go into your Ultimate Traders package, you should be able to download it from there. Okay? Since you're in the online university anyway, and from the online university, if you go to My Courses instead of the Analyst On Demand section and you went into the Ultimate Traders package, you would also be able to access the Wealth and Freedom Manual, okay, under the Wealth and Freedom section. Now, what we're going to be talking about is one of the strategies that gets discussed in that section. It's going to be strategy number 4. So I'm going to scroll all the way to strategy number 4. All right, and let's talk about strategy number 4. Strategy number 4 is steps 1 and 2 of the FX Chiefs 1, 2, 3 strategy. All right, steps 1 and 2 of the FX Chiefs 1, 2, 3 strategy. What strategy number 4 entails is to being able to enter into counter trendline breaks inside the ABCD price swing to go to the D extension. All right? So what we're effectively looking for is for the market to give us signals that it's getting ready to continue in the direction of the trend. So here's what we mean by that. Before we begin, does anyone have a currency that they would like to do this on? Any particular currency that they would like to discuss this on? Please feel free to type that in to the chat box. Okay, Shane, is there a time frame that you would like? Because this information is applicable to any currency pair, any time frames. The same methodology we're going to follow. Okay, so we'll start with the monthly chart. Let's go ahead, create a new chart for the Euro US dollar. Actually, let me go to my teaching workspace. Okay, new chart. And we'll do the monthly chart. Euro US 1 month chart. Okay. The first thing that we do when we take a look at a chart is what? What is the first thing that we need to identify when we take a look at a chart? Hang on a sec, I gotta pull some information that I want to share with you all. The first thing that we should do is identify trend direction, right? And the reason why this is important is because the trend line does a few things for us. I'm sharing these notes with you as we go along. The function of the trend line is to separate the market into buy and sell zones for us. Let us know what direction the market has been going in and point out what direction the market is potentially going to go in, right? Where the market may bounce. So the first thing that we want to do when we take a look at a chart is we want to compress the chart as much as we can so that we can identify the origin of any trends that appear, and then we want to begin from that point and go forward, right? So I'm going to, for the sake, because this is not an appropriate low with 2 to the left, 2 to the right, I'm going to add a few more bars of memory to this chart just to make sure. I'm pretty sure that this is as far back as it goes, but I'm going to kick this up to 5,000 bars. Yeah, the furthest this goes back is to 2001. So I would draw my trend line by identifying first and foremost the highest high of the chart and the lowest low of the chart. right? In this case, this is not a low with 2 to the left, 2 to the right. So what the smart Fibonacci is going to do is it should move to the next point. It's going to try to attach to a low. See, it moves straight over here to this point. So it goes from the lowest low to the first high. And I'm pretty sure actually if I were to draw just a manual Fibonacci just to test something. Yeah, right? If this were, that's interesting, isn't it? If this were right here, because we need a low with 2 to the left, 2 to the right to be able to draw one. So if this were a low with 2 to the left and 2 to the right, and I drew A to B, this would still be the C retracement. And the D extension would still be being fulfilled at this high, 2 to the left, 2 to the right. So as far as the Fibonacci's are concerned, this does not affect it in any way, shape, or form. Does that make sense? Any questions on that? Okay. So let me go ahead. I'm going to remove everything from here. I'm going to put in the trend lines, right, because we want to identify what the current trend is. So according to the chart, this is the lowest low, this is the highest high. My trend line would look like this. I'm going to come out and across all my lows of support for an uptrend, and I would come with an inner trend line like this, right, and that's my trend. Right, outer trend line, inner trend line. And we can see the market moving in these waves. The Fibonacci waves, or the Fibonacci's, are what we use to keep track of these waves, right? So what we would do based on all the things that we've discussed this week on ABCDs, we would plot our ABCDs on the chart just to track where the current trend is. As we can see, the uptrend that we've been tracking here, starting at the lowest low to the highest high, has been broken. Capital A, B boundary has been broken, and the trend lines have both been broken, which indicates that this trend is at an end. Is everybody okay with that? Does that make sense? So that means we would move on then. If this uptrend that we've been tracking has been taken out, we're going to move on. We're going to identify moving forward then the new trend that's in place. The uptrend has been taken out, meaning that a downtrend must be in place right now. So I'm going to identify the highest high of that downtrend and the lowest low of that downtrend over here by current. And I'm going to take a look at these highs, 1.6018. This is a high, 1.6036. So that is the highest high. I would draw my trend lines based off of the new trend out and across all my highs of resistance, out and across all my highs of resistance before the lowest low, right? And plot the ABCDs here. Starting from the highest high, this takes us to the current monthly AB boundary. It's actually still in effect, very, very close to being fulfilled. Okay. One very interesting thing that we can see with respect to this, even though it's just one AB boundary, this is actually a perfect example of things that we need to be paying attention to. Here's my A up here, price by 1.6036. And let's identify that. A, 1.6036. I have my B down here at price point 1.2329. And I've got my C retracement so far right here. This is the nearest point to the capital A after the capital B. So this C retracement is a 618 since it has not touched the 786 retracement price. The projected D extension target then is expected to be the 1.618. Everybody in agreement with all of that? Okay. So what we can see here overall is this market consistently making lower highs, lower lows in the direction of the trend toward the D extension. But so far, since May of 2008, this includes the Brexit, this market has still not fulfilled the D extension. So what we're looking for ideally when we're trading A, B, C, Ds, ideally we're looking for the C to be able to get in and take the ride all the way to D. But what if I missed this entry opportunity right here? Right? Would everybody agree this at the C there is subsequently after a bearish decision candlestick formation? And then the market over time did indeed start to move in the direction of the trend. But what if I miss this entry? Am I just done? Not necessarily. Okay? The methodology that we're talking about is, as we can see, the market overall is moving toward the D extension, but the market isn't making a straight line toward the D extension. Instead, it's moving in waves. Our overall trend line keeps track of the general trend direction, right? So as the market moves from A to B, B to C, C to D, we can see where the market's been bouncing, right? And our goal naturally is to look to participate when the market is moving in the direction of the trend, trying to take the profit, right? When the market moves from C to D, we're trying to take the profit, get in and take the ride all the way up to the D, right? Each time. The thing is that the market may not make a straight move to the D extension like we've seen here. The market's going to retrace or pull back against the trend, and we want to be aware of when these pullbacks are occurring, because when the pullbacks are occurring, since the market is moving against the trend, the market is actually moving against us, and these are times to stay out of the market. We can actually monitor this just the way that the trend line monitors the overall trend direction. We can monitor this, the counter trend line, movement against the trend. Because just as we discussed earlier during the week, for those of you that were here, when we were talking about the King's Crown, what does the King's Crown identify? What is the main function of the King's Crown? To identify reversals, exactly. To identify reversals, right? And so a reversal, exactly, Shane, is a change in direction. What is the first thing that happens when the market is changing direction or reversing? What is the first step of the crown? What is the first signal that the market is changing direction? The break of the trend line. The break of the trend line. So if a break of a trend line is the first signal that we have that the market is changing direction, and we apply that same methodology, that same rationale to what we're looking at here, that changes our potential drastically. Because what we're looking at then is, if we're monitoring movement against the trend, when the market is retracing with a trend line and the market manages to break that trend line, then that's a signal that the market is getting ready to change direction. But the change in direction is going to be in favor of the overall trend. So when we get breaks of the counter trend line, we have opportunities to be able to participate. These are the signals that we're looking for to be able to participate in the direction of the trend. Okay? So here's what we need to be able to draw counter trend lines, right? The function of the counter trend line is to measure retracement action, and they require a minimum of 3 retracement candles. Here's some more notes that I've composed for you. They require a minimum of 3 retracement candles to be able to be drawn. And I'll post this in the chat box. A minimum of 3 retracement candles to be drawn. Now the retracement candles, traders, that's going to be arbitrary to what kind of trend we're looking at, right? In the case of a uptrend, we're going to be looking for bearish candles as our retracement candles. Any candles that are moving against the trend, that is a retracement. So in the case of an uptrend, bearish candles are going to be retracement candles. In the case of a downtrend, bullish candles are going to be considered retracement candles. And we need a minimum of 3. They don't require a specific angle. They don't require a specific angle. They're not required to be in sequence either. So there may be some candles in between. What is important is that we can identify movement against the trend. So if we're working within the constraints of the current example, let's go back to the formation of the AB boundary. Right? Here's the AB with 2 to the left and 2 to the right. Now, this is a down AB boundary. In order for me to draw a counter trend line, I need a minimum of 3 retracement candles. What kind of candles am I looking for in this downtrend? Bullish candles, exactly. Retracement candles in a downtrend are bullish candles. So I'm looking for a minimum of 3. The next candle is a bearish candle, and then the market makes a lower low, so that's a push in the direction of the trend. Right? Once again, I get another bullish candle, and then another bullish candle, and another bullish candle. Now I have 3 bullish body candles, and I can see the movement against the trend. This is considered enough for me to be able to draw a counter trend line. Now, one of the finer points of drawing counter trend lines, traders can get a little bent out of shape or hung up on how exactly to draw it. So the first thing that I want to point out is you can start at either a wick or you can start at the bodies. The premise is that you are looking to have an aggressive enough line to be able to identify entry. You can start at a wick or you can start at the body. It does not matter. You can break wicks that stick out. What is important is that we are going across the bodies of the candles, not breaking any candle bodies. All right? Any questions on that? We are going across the candle bodies, not breaking any candle bodies. Okay. If we have any long wicks that stick out, that's okay. We can break the wicks. Doesn't matter. We're going across candle bodies. With respect to the angle, there is no specific angle that we have to, without fail, follow. Okay? When we're talking about the angle line, there is a tool, this tool right here, the trend angle tool, where if you draw a line, it will give you a number for the angle. Okay? The market is known to extend in 25-degree lines and retrace in 30-degree lines. Okay? These are one of the things that you learn in the Ultimate Traders Package, specifically during the Wealth and Freedom Experience. You talk about this. Okay? These lines are not necessary to be able to draw a counter trend line. There is no specific angle. The purpose of these lines is for when you're trading during the active zone and to be able to maintain an entry. Right? So for example, in an uptrend, if the FX chief is getting ready to trade during the active zone and he's got an up AB boundary and the AB boundary is getting ready to, it has just formed, that means that more than likely it's getting ready to retrace, right? Because the next thing that the market does when it creates an AB is pull back to give a C. So what he will do then is, if the market's getting ready to pull back, he may consider entering in counter trend lines short term, since it's the active zone, and he may put in a 30-degree line at the height, expecting that as long as the market continues to retrace below that line, he's got a pretty safe entry. Should the market break that line, it would be a signal to get out of the position. Right? This would be for a retracement, and the 25-degree line for an extension. If he identifies that the market has created a C, which is going to give us the highest percentage chance of success anyway, right? If the market has created a C instead and he gets an entry opportunity and buys the C, then he'd put a 25-degree line at the low there, and as long as the market continues to extend above that line, he can maintain the position. Should the market break that line, then the position should be canceled out. Does that make sense? Any questions on the angle line? This is not what we're going to be using when we're talking about counter trend lines, because these lines are only used to maintain an entry that's already been placed, whereas the counter trend line is used to help identify that entry. So we are not going to be using the angle lines for that. You can use the angle line once you get involved, but we're not going to be using the angle line to identify a counter trend line. If you do choose to use the angle line, once you've found an entry, if you do choose to use the angle line to maintain your entry, make sure that you draw a regular trend line over it, because the angle line, due to your degree of zoom, if you change your degree of zoom, your angle of the, in respect to the view of the chart, right? So if I draw an angle line, I'll just show you, right? If I put an angle line out like this, right? And I'm going to, as a matter of fact, I'll do it up against candles so you can see how the candles, the perspective of the candles doesn't change. I'm going to overlap this with a regular trend line of a different color, right? So here's a regular, oh, nope. Here's a regular trend line drawn directly over that line. I'm going to make it slightly longer so that I can manipulate if need be. All right, I'm going to change my zoom by zooming out a little bit. They're both overlap, so you can't see the angle line underneath it. If I zoom out, you see now you can see the black line, and if I continue to do that, it gets more and more severe. Right? Look at that. The trend line doesn't change, look exactly the same, but the angle line does change. And this happens in every single currency, in every single software that I've seen. Same thing, right? The angle line will dance about based on your zoom. So we don't want to have to worry about that if we're in a position, maintaining a position, and we want to know when to get out. It's not a good idea to have your guideline be dancing about on a chart. So I would strongly suggest, if you do decide to use the angle line, just draw your appropriate angle, then draw a regular trend line over it and just delete the angle line. Right? And go based off the trend line. Okay? If anybody has any questions on that, please let me know. That's kind of neither here nor there, but it will affect your trading, so I want to make sure that you're aware of it. Back to counter trend lines. Excuse me. When we're dealing with the counter trend lines, again, we identified 1, 2, 3 retracement candles. So we're looking to draw the counter trend line again across the bodies. The only thing that is allowed to break the counter trend line is going to be a decision candlestick formation in the direction of the trend, because that's what we're going to be using as a trigger to be able to participate. So we're looking for a decision candlestick formation to be the only thing that breaks our counter trend line. If I get anything that is not a decision candlestick formation attempting to break that counter trend line, what I'm going to do is I'm going to adjust my counter trend line. You see this right here? This is trying to break my counter trend line, but This is not a decision candlestick formation in the direction of the trend. So I would adjust my counter trend line, absorb that into the retracement, even if it is a bearish candle. If it's not a decision bearish candlestick formation, I'm looking for something, a entry signal, and if the market's not giving me that, then I don't have that entry. I'm not going to get involved. So let's continue here. Here's another retracement candle, another retracement candle. I absorb that into my counter trend line. And when the market gives me a break in the direction of the trend with a bearish decision candlestick formation, this is what I will qualify as an entry. There's my break. I can look to enter into this based off of whatever strategy I've chosen. So if I'm trading A, B, C, Ds, my stop loss is going to go beyond the A, and I'm going to look to limit out at the D extension, the appropriate D extension. In this case, it would have been the 1.618. If I'm trading a candlestick formation, then my stop loss will go above the candlestick formation, 15 pips above, and I'm going to look to go toward either the D extension or a lower low that makes equity management sense. Okay, all this is mentioned in the actual strategy. I'm going to look for the candles of retracement, draw the counter trend line underneath the bullish candles, and enter into the market selling when the market creates a bearish candlestick formation and or breaks the down counter trend line with a bearish candlestick that closes 75% or more beyond the down counter trend line. When it comes to your stop losses, here you've got your options, right? Depending on your style of trading. If you're a position trader, then you're going to be looking at time frames larger than 1 hour. Usually, even position traders on a speculative nature, right? Traders that are looking to capture profit on the price movement and not be involved for a super long period of time. These traders are looking maximum at an 8-hour chart, and I don't know many that do, to place the position on their trade. I don't know too many traders that trade time frames larger than the 8-hour chart. Traders that are trading on the institutional level may look to place positions on the daily, the weekly, or the monthly, but for the most part, speculative traders like us don't really look to trade the larger time frames than that because you're usually dealing with way too much risk. The AB boundaries are simply too massive and call for too huge a risk. And not to mention the fact the current AB boundary that we're looking at right now is a classic example of just how long a larger time frame ABCD can take place in, right? Since 2008, the current AB boundary has been in place, the current downtrend AB boundary has been in place, and still has not been fulfilled in 2017. First quarter 2017 just about over and still not fulfilled. Okay, so if you find your entry opportunity, you can put your stop loss either beyond the A, beyond the 25-degree line, or beyond the candlestick formation. If you're buying, 10 pips below. If you're selling, 15 pips above. Right? And as far as your limit target, and with the stop loss before I continue, with the stop loss, remember that if you decide to put one of the tighter stop losses, when you place your stop loss inside the AB boundary, you increase your chances of being taken out early by 80%. So the best place to place our stop loss is going to be beyond the A. So we give the market the room that it needs to be able to breathe. Okay? That's not always going to be the case. We may not always have that option, but it is the best option. When it comes to your limits, again, based on whatever strategy you identify with, you can either figure out what the daily trading range is and look to exit 10 pips before it hits the daily trading range. You can look to exit at the D extension if you're trading ABCDs, or if you're trading aggressively during the active zone using the 25-degree line, then if the market breaks the 25-degree line and closes beyond it, then you can look to go ahead and close your position. Right? So in this case, we had that situation take place where the market did form a bearish decision candlestick formation and broke the counter trend line, and we had the entry right here. So where's my stop loss going to go if this is the case? I would enter in at the close of the candle. Where would the stop loss go? Exactly. It's going to be 15 pips beyond the A up here. Okay, in this chart you'll barely be able to see it, but I'm going to put it slightly higher so everyone will be able to see it. 15 pips beyond the A. If I'm trading the candlestick formation, 15 pips beyond the candlestick formation. Or if I drew the line, the line would be my directive. I'd have to watch the line. Okay. The limit target is going to be 10 pips in front of the D extension. We're always looking to limit out before the market actually makes it to the D target. So if the market, for whatever reason, were to go near the D extension, which it does quite often, but doesn't quite touch it and pulls back, we don't get sucked in to the pullback. We can simply exit. Okay? So let's go ahead, let's continue. Here's the potential entry position that we identified there. The market made its way down to the low and then creates a low at a level of support. And here I have 1, 2 bullish candlestick formations. So with 2 bullish candlestick formations, I need a third. There is my third. I can once again draw a counter trend line. If I miss this initial entry opportunity and miss the profit that came with it, I may have another opportunity to be able to participate in the direction of the trend. With this counter trend line, we can already see that we're quite far away from the third candle, right? We are going across the bodies, but we are quite far away from the third candle. If I were to get, here's the break and another potential opportunity. If this market continues to pull away really aggressively like this and gives me more bullish candles, as long as I have 3 bullish candles, let's say I get another bullish candle like this. As long as I have 3 bullish candles, I can actually redraw the counter trend line more aggressively. Because all I need to be able to follow the rules is 3 retracement candles. So as long as I get the retracement candles, I can draw the counter trend line. Any questions on that? All right, so that's another potential entry opportunity that we've got right there when the market broke the counter trend line. Market started to move in the direction of the trend a little and then pull back once again. So another opportunity to draw another counter trend line. Candlesticks that move against the trend, we draw the counter trend line. Once again, we're looking for a decision candlestick formation to break the counter trend line. Would this qualify as a break of my counter trend line? Since the bodies are bearish, would this qualify as an entry? Not in the slightest, right? Not in the slightest. We are looking at indecision candlestick formation. So since the market's not giving us decision candlestick formations breaking to the south in the direction of the bears, we'd have to swallow all this into the retracement. It's only at this candle right here that we've got another potential entry opportunity. So far, same AB boundary, counter trend line entry opportunity, counter trend line entry opportunity, and here's a third. What you'll notice is each time that you get these counter trend line breaks, you'll get a move in the direction of the trend, right? A move in the direction of the trend. So once again, that's the point. That's what we're looking for. This is how we identify entry opportunities within and without the AB boundary. These are the first 2 steps in the FX Chiefs 1, 2, 3. I'm sure you guys have heard the 1, 2, 3 a few times by now. These are steps 1 and 2. Right? Indecision candle, all this indecision. Counter trend line with spread like this. decision candlestick formation, move in the direction of the trend. It's another counter trend line situation right here. All this is indecision, so you'd have to spread like this. If this starts to flatline on you, what you're looking at instead, that's a lot of indecision going on. If I were to see something like this, right? Here's 1, 2, 3. This is the first place where I could actually draw the counter trend line. First and foremost, I have a sequence of indecision candles. The angle that I'm looking at here is very slight, but I've got a sequence of indecision candles. What is this most likely going to translate to on a smaller time frame? Yeah, exactly. It's going to translate to a consolidation range. It's going to translate to a consolidation range. Consolidation is a period of indecision. Consolidation is where the market doesn't know where it wants to go. So if you're inside of a consolidation range, or if you haven't noticed it, eventually you will, right? You identify your average height of resistance, your average depth of support, right? And you can identify what kind of consolidation range you have. Distance between the 2 points, if it's greater than 150 pips, which it is, 510 pips, you can look for opportunities to buy at support or sell at resistance. Granted, on this time frame, since the candles are so massive, not really giving you too much opportunity here to be able to do that, right? You're looking at a bunch of huge indecision candles. So you'd probably be better off looking to participate on a smaller time frame, a little bit more proactive than reactive here in this case. All right, eventually we get the break out of the consolidation range. When the market breaks out of the consolidation range, you can look to participate in that direction. Right? And this is where we end up at current. Any questions on identifying counter trend lines and their breaks, as well as the entry signals? And actually, I would adjust this, considering the current market condition, to include this down here. Any questions on this? Everybody clear on this? Right. Now, we've got a few moments here left, so just very quickly so that I make sure that we cover this on both ends. If we're in an uptrend, traders, remember that your uptrend situation is going to be a little different. Your retracement candles are going to be bearish candles. So in an uptrend situation, if my uptrend line is here, right, I've got the outer trend line right here, inner trend line like so, and if I'm drawing my counter trend lines, I'm going across bearish candles. These are retracement candles. So once again, counter trend line, there's my bullish break and the subsequent move in the direction of the trend. Counter trend lines, bullish break, subsequent movement in the direction of the trend. Counter trend line, bullish break, movement in the trend direction, right? So our counter trend lines must always go against the normal or the natural trend line. And always against counter trend, against the trend. Okay? With that, we are going to wrap up this discussion on the counter trend lines. Strategy number 4 of the Wealth and Freedom Manual. Hopefully everyone's gotten some insight as far as helping to be able to identify entry opportunities within the AB boundary. Even if you've missed what is the current C, the nearest point to the A after the B, there may still be entry opportunities for you. So we're going to take a short break. We're going to come back at 10:30 p.m. Eastern Time for the final segment for this week. This has been Will Gomez, FX Showtime. I'll see you in a few moments.